possibly next week more. All right. So there's quite a number of topics that you are expected to complete before test one. All right. So I think the biggest on the topics that you have to write on assessment one should be financial instruments. All right. So we should spend a good time, maybe 3 weeks or so, looking at financial instruments. All right. Then so there's changes in accounting policies. That's IAS 8. All right. And then there's conceptual framework, there's income tax, there's IAS 21. All right, so we're gonna look at all those topics before you write. But of course, IAS 21 is not a big standard. It's about foreign exchange transaction. All right, talk about presentation currency and all that. So maybe we'll spend maybe 30 minutes or so looking at it. All right. So what I'm gonna do, all right, I also do level one students. All right. So there are common topics, all right, like for example, um, IAS 8, change in accounting policies, conceptual framework. So when I'm looking at those topics with the level one guys, I'll invite you guys to also join them. All right. But anyway, let's look at income tax. All right. So basically what's happening now under the income tax, all right, is the accountants, they will prepare the statement of profit and loss. All right. So accountants are going to prepare the statement of profit and loss. All right. So on the statement of profit and loss now, that's where there will be profit. All right. That's going to be calculated. But however, now, all right, we now need to determine, all right, how much is taxable with regards to the profit that's been made. But now the challenge kicks in where now we have to understand there are differences. All right, there are different principles which are applied now in the calculation of profit before tax, and different principles applied in the calculation of current tax. All right, so it's essentially important that we're in position to integrate those knowledge and reverse the different principles. All right, let's look for example now. Accounting principles versus taxation principles. Right, so we want to look now, rather than calculating normal income tax, all right? So accounting, all right? Let's have accounting, then we have taxation this side. All right, so in terms of this, things like dividend received, all right? In the hands of accountant, dividend received, this is actually income. I'm sure you agree with me that when you're preparing the statement of financial position, you record dividend received as income. So we record it as part of other income. All right, that's what we included. But for taxation, dividend received now, all right? If it's a local dividend, how do you do with that? All right, remember now, dividend received, we include it in gross income. Then we take it out as well in terms of section 10 of the Income Tax Act. So this is exempt income. You see, so now there's a challenge. But remember, you want to prepare your profit. So you want to prepare your normal income tax. Your starting point is profit before tax. Now, in the profit before tax, there's dividend received, which the accountant treated as income. You see that? So now, all right, because now our starting point when calculating normal income tax is profit before tax. All right. And dividend received is included in profit before tax. So dividend received is included in profit before tax. So what do we do? Since now dividend received are exempt from taxation, we need to remove or reverse dividend received from profit before tax. But I don't know if it's making sense, this principle so far, before we go anywhere.
Yes, it is making sense.
It is making sense. All right.
Yeah.
Okay, cool. So basically that is with the logic behind the calculation that we're going to be looking at. So if you master this principle, that means now everything else is going to start to fall in place. All right, then we have things like fines and penalties. Now, fines and penalties, accounting, they treat this as an expense. All right, so in fines and penalties, we treat fines and penalties an expense. All right, but now SARS, all right, or taxation, how are they treating this? SARS is coming and say fines and penalties are prohibited deductions, right? In terms of section 23M. So these are prohibited deductions. So with regards to this now, that means now we need to reverse this from the profit before tax that we are given there. So basically that's what we have, or that's the logic that kicks in with regards to the calculation of our normal income tax when we have profit before tax. All right. And then now, the next thing now, all right, with that now being mentioned, all right, we now need to look at some other items. All right, we have things like profit on self. Okay, let's look at foreign income. All right. Now, what happens with foreign income? Remember now, foreign income, all right, for taxation, foreign income is subject to different rebates. All right, remember we have 6-quart rebate. That's a rebate that governs foreign income. So in terms of this, all right, so that means now foreign income is included as other income by accounting. All right, then taxation, right? How does taxation treat foreign income? Foreign income is exempt from taxation. So that's the logic behind this. So foreign income now is exempt from taxation. What does it mean? It means now to correct that, we need to reverse the foreign income as well from our calculation. All right, then look at the last part, self and asset. Now, when there's a self and asset, accountants calculate profit or sell or loss on sell at 100%. So we calculate the difference between the carrying amount minus the selling price. So that's what they give us the accounting profit on self and asset. All right, now self and asset. All right, of course, before we think about recoupment, upon self and asset, taxation calculates capital gains tax. So calculate capital gains tax at 80%. All right, so in regards to this, we're going to calculate capital gains tax at 80%, which means now, all right, you see, accountants, when they were calculating now their profit before tax, they included 100% of the profit. But SARS is coming in and saying, no, in regards to this, we're only taxing 80% of capital gains tax, which means now 20%, you see 20% difference between 100% and 80%, 20% of the capital gain is not taxed. All right, so we need to reverse this amount. All right, how do you calculate the reversal of this amount? So we're going to take selling price less cost. Then you multiply everything with 20%. So that's what will then give us the amount that we reverse. So we're going to deduct this from profit before tax. All right. So basically, that is how we go about it when you're dealing with self and asset. All right. So that's how we go about it in terms of that. So with these principles now mentioned, all right, let's now lay out what is expected of us by the examiners there. All right. So in terms of income tax, the examiners might ask us to calculate normal income tax. All right, they might ask us to present the notes of the income tax expense note. All right, they can ask us for that. All right, they can ask us to calculate deferred tax as well. So they can do that. All right, or they can bring a theory question to say discuss the deferred tax implications of the transaction. All right, so those are the areas that the examiners can ask us in regards to this. All right, now let's look at the framework. All right, what makes up the notes, all right, to the normal income tax. So we need to look at the framework there. So notes, all right, let's say income tax expense note. Right, so the examiners, they can ask us to say, prepare the normal income tax expense note. All right, what is expected in regards to this? All right, so we write down, all right, we have different components. We have income tax expense. All right, then we write major components. Right, so what's happening in regards to this? We're giving a breakdown of the items making up tax expense. All right, now we need to understand that tax expense, all right, it can be made up of South African tax. It also includes foreign tax, all right? It also includes things like probably deferred tax as well, all right? We're going to touch on that just now. So basically, that's what we have, and also it includes changing tax rate. So let's look at it and see now the income tax expense note. All right, so we have SA normal tax. All right, SA normal tax. All right, so SA normal tax is made up of what? Current year tax. All right, which is the normal tax that you calculate there. All right. So this is income tax calculated in current year. All right, so we have it sitting in there. All right, and then we then look at probably if in the previous year, remember they pay provisional tax in the previous year. So if in the previous year there was an over provision, so you charged too much tax in the previous year, we include it here. Or in the previous year, if there was an under provision, so that means they paid lesser tax, we also include it there. So we have over provision previous year. All right. So this is the provisional tax that's coming from the previous year. So if it's an over provision, we deduct it there. All right. Then the net off between these two amounts is what then give us SA normal tax. All right. So we have the SA normal tax sitting in like that. All right. Then we look at deferred tax. All right. Now, what is deferred tax? Deferred tax stands for future tax. You know, so this is the amounts now that we're expecting to give us taxation in the future. All right, so we have movement in temporary difference. We're going to touch on that as well. All right, to see what's happening. So we have movement in temporary difference. All right, we record it this column. All right, then we have change in tax rate. All right, so I'm going to show you how the change in tax rate affects the deferred tax and all that. So what's happening is, take for example, in 2023, the tax rate was, so in 2022, the tax rate was about 28%. All right, but this year, what is the tax rate? You see, in the previous year budget speech, they reduced the tax rate to 27%, which means now the tax rate decreased. So what's happening now is temporary differences, all right, they would have been calculated based on the current year tax, all right, but however now, we now need to understand what is the effect, all right, remember the tax rate now, the movement in temporary difference or comparing prior and current year temporary differences, all right, so the change in tax rate, it helps us also to adjust with the effects of the change in tax rate. So we're trying to compare apples with apples. I'll show you when you do the calculation of change in tax rate just now. All right. So we have change in tax rate. All right. In regards to that, it's sitting there. So if there's a decrease in tax rate, that means we deduct it. All right. If there's an increase in tax rate, that means we deduct it. We add. So decrease in tax rate. All right. We can call it change in tax rate then. All right. Then you take you there. All right. Then you net off these two amounts. That's what will give you your deferred tax there. So you have your deferred tax sitting in there. All right, once you have a deferred tax, this is what will give you SA normal tax. All right, so in regards to this, SA normal tax expense. So you're going to add the deferred tax plus SA normal tax. All right, then take you to this amount there. All right, you have your balance sitting there. Then after that, all right, you then have your foreign tax, if there's some form of foreign tax there. Foreign tax, so include your foreign tax here. All right, so then it gives you your total taxation there. So that is how we go about it when they ask us for the normal income tax expense note. Right, then also forming part of the normal income tax expense note is tax reconciliation. All right, we're going to touch on what's happening in terms of tax reconciliation. But for now, you need to understand on tax reconciliation, the starting point is profit before tax. Right, so your starting point is profit before tax. All right, then after that, so you have, so everything else forming part of tax reconciliation is multiplied by the tax rate. Or transactions making up tax reconciliation are multiplied by tax rate. Right, so you multiply everything with your tax rate in that regard. So here, the standard rate, you take a profit before tax, multiply by tax rate. Right, so then give you a balance sitting in here. Right, and then, of course, after that, right, so you have your standard rate sitting there. Then you now need to adjust. All right, so you tax reconciliation and then adjust with non-deductible item or non-taxable items, or what we can call exempt items. All right, so we have non-deductible items. All right, so on the non-deductible items, that's where you include now those items which are exempt from taxation. Like, for example, the list that we listed up there. All right, remember I was mentioning about dividend received. All right, so you have your dividend received multiplied with tax rate. All right, then you get your balance. So remember, we said these items were included in profit before tax. So we're going to reverse them. So dividend received, we need to reverse it. All right, so we deduct it. All right, that's how we're going to go about it. All right, and then we move on to foreign. Okay, let's do foreign income at the end. Fines and penalties. So if fines and penalties, you also multiply with tax rate. All right, so fines and penalties was an expense. So it means it was previously deducted and coming up with profit before tax. So to reverse it, we add it back. All right. And then you have now capital gain. Remember now, we said portion of capital gains is taxed at, it is not taxed. So 20% of the capital gain is not taxed. All right, so you take 20% times selling price minus cost of the asset. Then you multiply whatever answer you get by the tax rate. All right, so then give you the, if it's a capital gain, you deduct it. If it's a capital loss, you add it back. All right, so that's what you have in terms of this, all right, this part. And then you have foreign income. All right, so with regards to foreign income, so in other words, you're saying SA, foreign tax, SA, foreign income, times tax rate minus foreign income. Foreign tax, I mean, right? You deduct the foreign tax. If it's not given, you just take the foreign income times the foreign tax rate. All right, so that's how we go about it, right? In terms of this part there, all right, of your tax reconciliation there. And then it give you a balance there. So if it's SA foreign income times the SA tax rate is higher than foreign tax, then you deduct. But if SA foreign income times tax rate is less than foreign tax, that means you add back. All right. And then if there's change in tax rate, right, you also account for it here. So if the tax rate is increasing, all right, sorry, it's decreasing, that means you deduct. If the tax rate is increasing, you add back there. All right. And then if there's an over provision, all right, in regards to this, if there's over provision, all right, in prior year, right, so you paid more provisional tax in the prior year. So the over provision you deducted here. All right. Then this is what will give you effective income tax. All right, so you have the effective income tax sitting in there. All right, so one of the years, all right, about doing the tax recon. In that year, they asked for tax recon in percentages. All right, I'm sure just that UNISA doesn't examine it that way, but I'm sure one of the days I'll show you guys how to do the tax recon in percentages. All right, then we do deferred tax note. All right, so in terms of deferred tax note, so just an analysis of temporary difference. All right, so you have your analysis of temporary difference. All right, so in regards to this, you look at if there's any items making up property, plant, and equipment. All right, so you just record the deferred tax that comes from PPE items. So you're talking about machinery, equipment, and all that. So you combine the deferred tax of those items. All right, we just say property, plant, and equipment. So you combine deferred tax from those items. All right, you record it here. All right, then if there's any form of assets, for example, revenue in advance, you record it there. Revenue in advance give rise to deferred tax liability. All right, and then if there is unused credit losses, right, so if there's unused credit losses, you deduct it like that. All right, then you have your net deferred tax. It can be asset or liability. All right, so you're sitting with your net balance then. All right, so basically this is what we have as part of the notes. All right, now, before we go anywhere, let's look at calculation of normal income tax. All right, it's quite essentially important that we have an understanding of how we go about it when we're calculating normal income tax. All right. So we did touch a little bit, all right, in terms of this. All right, so we now want to proceed, all right, to see what's happening there. All right. So in terms of this, how do you go about it? So the normal income tax, the starting point is profit before tax. So always start with all right, so we'll start off with profit before tax. So we have profit before tax. Right, but now, since you guys are being examined on changing accounting estimates, all right, what happens is if we're starting off with this part, all right, if we're starting off with IS 8, sometimes they can ask you to do the calculation of, there could be errors in the profit before tax. So you might be required to amend the given profit before tax with IS 8 principle. There could be errors or there could be changes in accounting estimate, all right, which might affect your profit. So just be careful in terms of your calculations there. All right, so we then have our profit before tax as our starting point. Then we have non-deductible items. All right, so non-deductible items are those transactions that are exempt from taxation. So no tax implication for this transaction. So in other words, in simple terms, exempt from taxation. All right. So these are the transactions that we say, no, they don't have taxation implication. Right? Like, for example, they don't have no more tax implication. All right. Not taxation implication, but no more tax implication. So like, for example, dividend received. Now, we both know that dividend received is exempt from normal tax. All right. Remember, why is it exempt? Because it's subject to dividend tax. I'm sure you guys, you're going to look at dividend tax, I think section 64. right, of the normal income tax, somewhere around section 64 of the normal income tax. That's what we touch on, dividend tax. So dividend now, it was previously added as part of other income. So now to remove it from profit before tax, we need to remove it. All right, so we have dividend, and then we have fines and penalties. Right, it can be a fine for late payment of VAT, a fine for speeding and anything. Right, these are prohibited deductions. Right, so they're prohibited deductions. So which means now these amounts were added. Right, we did add them. We're not calculating the profit before tax. All right, so we deducted them. Now we're reversing them by deducting them. All right, sorry, Miss Julie. I think for a second your question almost confused me. All right, so Miss Julie is saying we don't multiply by anything. No, when you're calculating normal income tax, so far we don't multiply anything. All right, the only time we multiply each element is when we're doing tax reconciliation. All right, so far, for now, we don't multiply anything for now. All right, now let's look at the next part. All right, so we have capital gain on sold asset. All right, so in terms of this, how do we go about it? So we're going to take 20% of selling price minus cost. All right, so you multiply 20% of selling price minus cost. That's what's going to give you the balance. But because now this amount it was a gain, it was added. All right, remember the account added 100% profit, which means now 20% of this amount is not supposed to be taxed. Remember, we explained that CGT is actually at 80%. All right, so we reverse the 20% in regards to this. Then the next thing, all right, that we now want to look at, all right, in terms of this is foreign income. So in terms of this, foreign income is exempt from local tax. All right, but of course, it's a longer principle type that when you're dealing with taxation. All right, but of course, foreign income is exempt, so initial accountants added them for calculating profit. So to reverse it, we deduct it. All right, so that's what we have as part of foreign income then. All right, then we come back after that. We're going to come back to what is left, maybe donations. All right, so donations received. So normally, in terms of donations, all right, remember, if it's a registered public benefit organization, all right, Section 18A certificate, right, they're not taxed, so they're exempt. So in regards to this, we just have to reverse it by deducting it. All right, then on depreciation, all right, sometimes we have some assets that have depreciation. All right. But now SARS does not grant capital allowances on those assets. So we have to account for those assets. So depreciation assets without capital allowances. All right. A very good example of assets without capital allowances is actually administrative building. All right. Remember, Section 13 gives allowance to manufacturing building. Section 13 Queen gives allowance on manufacturing building. Then we have Section 13 SACS. It gives allowance to residential building. But there's no section that govern administrative building. So in this case, all right, when you have depreciation on such assets, we need to reverse it by adding it back then. All right. So this is what gives you your total non-deductible items. Then you have your temporary difference. Now, with regards to temporary difference, all right, this part, that's where now the trick kicks in, especially if you're coming from another institution. All right, the calculation. So from other institutions, there are two methods that we use to calculate temporary differences. Some institutions use statement of profit and loss method, all right? But UNISA uses statement of financial position method. Right, so I'm not gonna show you the method from other institution. I'm just gonna stick to UNISA since you guys are studying with UNISA. All right, so temporary difference, we use statement of financial position method. Right. How do you go about it? Right, in terms of this. So we then have, so let's say calculation of temporary difference. Right, so calculation of temporary difference. Right, so in terms of this, so we have to lay out. We use assets and liabilities only. Calculate temporary difference. But also you're going to use assets and liabilities only to calculate temporary differences. All right, how are we going to go about it? Right, in regards to that. So the approach now that we're going to use in regards to that calculation, we're going to take now carrying amount of the assets at the end. Carrying amount of the assets or liability at year end. Right, then we have tax based then. Right, then we have temporary differences. Now, with regards to your IFRS standard, right? In terms of your IFRS standard, if you open IAS 12, right? So IAS 12, that's the standard that governs, of course, this part of right. So you find they give you definitions of what is a temporal difference, what is tax based and all that. But let's try to look at it in simple English. So carrying amount, right? It's important that you guys understand what's happening. Now, before we get to, okay, let's look at, so carrying amount, all right? For an asset, carrying amount is the closing balance of the asset at year end. In simple terms, carrying amount is the closing balance of the asset at year end. Now, if an asset is sold during the year, do you guys agree with me that we don't have carrying amount of that asset at year end? All right. So now, for property, plant, and equipment assets or depreciable assets, right? For depreciable asset, carrying amount is equal to cost less accumulated depreciation. Impairment loss. All right. So that's how you go about it for depreciable asset. For example, it's a machinery. You take the cost of the machinery minus the depreciation that you had for the entire period in regards to this. All right. All right. So basically that's what we have in terms of this. All right. Now let's proceed now to the next part. All right. Tax base. So tax base now, all right, for an asset, all right, stands for future allowances, all right, or future deduction. For an asset, this is future deductions. All right, so in a simple terms, tax base is equal to cost of an asset less accumulated capital allowances. All right, so in regards to this, that's what it then give you this part of your formula there. So you then record, all right, if you have an asset, property, plant, and equipment. All right, you have property, plant, and equipment. So you record it like that. Then you have a temporary difference, then the difference between these two. So to give it a temporary difference there. All right, then, so temporary difference, all right, that we record in the calculation of normal tax. Is difference between carrying amount and tax base. So the difference between the carrying amount and the tax base, that's what it then give you this part of the question. All right. So in terms of this, all right, when you're calculating the temporary difference, we're saying the difference between carrying amount and the tax base. That's what it gives us that. So temporary difference. Recorded in calculating normal income tax is the movement in temporary difference, which is difference between current year temporary difference and prior year temporary difference. Right? So that's what we then record in our statement. So it is the difference between those two there. So that's what we have in terms of the calculation of temporary differences there. Right, let's look at it now to see what's happening there. Right, with that our simple example that we have here. Right, we're not going to do all of it, right, but let's look at it and see what's happening there. All right, so part B, right, it says disclose the notes, financial statements of April Limited for the year ended 20 February 2012 as required by S12 income taxes. Right, you see, so the question is asking for notes. Right, so question is asking for notes to the normal income tax. Now, it's essentially important, right, that we understand what type of notes we're required to prepare. Right? So I showed you the framework in terms of the notes for normal income tax. So this is the framework. So you're going to need, let's say, current year tax, right? So that we prepare the note. So how do you go about it, right? So before we do the note, we can do workings. Right? So under workings, we're going to calculate normal income tax, right? Or the current year normal tax. So you're going to start off with profit before tax. All right. So let's read through the information that we have here and see. All right. So, okay, before I go anywhere, let's read additional information. Say, please note, the movement in temporary difference in the current tax calculation must be calculated using the statement of financial position. Do you see? Remember, we mentioned that depending on the institution you're coming from, the movement in temporary difference for UNISA, it is always calculated using the statement of financial position method. So that's the method that we use then. Right, then comparative figures are not required and off amounts to the nearest one. Ignore that. So the following information was extracted from the books of and records of April Limited for the year ended 29 February 2012. The deferred tax liability as at 20 February 2011 was made up as follows. Do you see deferred tax for the previous year? Property, plant, and equipment, all right, sitting there. Contract liability sitting there. Profit before tax for the year ended 29 February 2012 amounted to 735,000 and included entirely the following items. Foreign income. You see, not taxable in South Africa. Tax is payable on this income and 35% in the foreign country. So sometimes what happens is, but also to avoid double tax, right? Sometimes with foreign income, you might be required to tax in the foreign country and in South Africa. So what countries do is they reach what we call double taxation agreement. We're going to touch on that on taxation, right? So in this case, it means that according to the agreement, this income is actually supposed to be taxed in the foreign country. So it's exempt as well in South Africa. All right. We have dividend received, not taxable. Profit on soft land. Capital gain for tax purposes, 210. Funds and donations, not tax deductible, 700. Legal fees, all right, not tax deductible. Then tax deductibility. Then depreciation on vehicles sitting there. Now let's look at this in terms of this transaction. So we said our starting point is always profit before tax. All right. So do you see we have profit before tax at 735? All right. So profit before tax, 735. What are we calculating here? Normal income tax. All right. This is not the note, but we're calculating normal income tax. All right. So we have profit before tax, then we have non-deductible items. What would you say they're called, so-called exempt items? So under non-deductible items, what do we have? All right, you see, we look at those items that are here, they recorded them as non-taxable in South Africa. So we have foreign income, Right? What are we doing? The foreign income was added. The accountant added this year. So to remove it, remember we want to calculate normal tax. So we need to remove it from the profit. So we deduct 132. I don't know if there's anyone who's lost so far. Yeah. So basically that's what we have. So foreign income, we reverse it. Then we have dividends received. We're going to reverse it as well. So we have dividend received. So because the dividend received, right, it was initially added when calculating profit. So to reverse it, we deduct it. So we're sitting with 175,000 there. That's dividend received. All right. And then profit on sale of land. All right. So capital gain, sale of land. Now, in terms of this, remember we said this calculation was saying selling price minus cost. But however, because here they said capital gain purposes. So in terms of this is 210. Remember, the profit on sale of land is calculated by taking selling price minus the cost. So we have 210 there. All right, so we have 210. So we're going to multiply it with 20%. Why? Because we said now with regards to capital gains, all right, capital gains is calculated at 80%. Profit on sale is calculated at 100%. So which means 20% of this amount is not taxed. So that's the amount we need to reverse. All right. So we have 210,000 times 20%. Take us there. Then we proceed. Next item. All right. So we have fines and donations, which are also not tax deductible. All right. So we told no fines and donations, they're not tax deductible. They're sitting at 700. So these are expenses. They initially deducted them. So to reverse, we add them back. All right. Then you have legal fees. All right. So we have not tax deductible 900. So we have legal fees. Right. So we have no tax deductible sitting at 900. We reverse it by adding it back. Then legal fees tax deductible. Do you see this one? It's tax deductible. So we don't do anything with this one. Why? Because both accountants and SARS are deducting this amount. So we are good. Right. So basically that's what we have as part of our non-deductible item. Then we come to temporary difference. Right? So we're gonna do the temporary difference, of course, on our next class. Are you guys comfortable joining the level 1 guys? Because for now, like I told you that we have similar sections. All right. I told you that income tax is the same for level 1 and level 2. All right. There are differences when you guys are doing financial instruments and IAS 21. So we can say, let's finish off normal income tax on Wednesday class at 18:30 or combining with the level 1 guys. Then from there, we do on Friday, we do financial instruments. Is it fine?
Yes.
Okay.
Yes.
All right, cool. So we're gonna finish it on Wednesday, 18:30. Right, but now what I want you guys to do now is please go through this recording. All right, if you feel lost, please ask. Run through it to have a better understanding. And if possible, you can complete it, you know, so that you won't get lost much when you're in the Wednesday class. All right, but before I move, let me just show you the tax reconciliation. Remember, the question is asking for notes. We have tax reconciliation note. All right, this note is actually easier. All right, so we have profit before tax. All right, which is 135,000. All right, so we have it here. So the 735, not 135. So we have 735. Right, then we have standard. Right, which means now, remember we said on tax reconciliation, everything is multiplied with what tax rate. So in this question, the tax rate was 20%. So we're going to take 735 times 20%. All right. Then we have those non-deductible items. dark items. So we're going to include, remember, we have all these items. So we have dividend received. All right, so dividend received, we said everything yes multiplied by tax rate. So dividend received 175. So 175 times 20%. So you do this when you're doing your tax reconciliation note. Right? Right, so you multiply with the tax rate, right? Then you have after dividend received, you have capital gain on soft land. All right. So in terms of this, so you can just take this 42,000. You can say 210 times 20% times 28% your tax rate. All right. So you're gonna reverse that. It's gonna sit there. You know, so that's the capital gain. Then your fines and donations. So fines and donations, all right. So in regards to this is 700. You also multiply with your tax rate, all right, which is going to take you here. So you have 700 times 28%. You reverse it by adding it back. Then legal fees, all right. So legal fees not tax deductible. So in terms of this, how much legal fees do you have? So you have 900 times 20%, all right. So you're going to add it back. So 900 times 20%. You have it stick there. All right, so for now, this is what I want you guys to master. All right, so we're going to pick it on the next class. All right. Any questions, you're more than welcome to ask there. All right, otherwise, have a good evening, guys. I'll see you on Wednesday for continuation of this class. All right, bye, guys.
Thank you very much, Ian.
All right, pleasure. Bye, guys.
Bye.